Has anyone ever asked, so, how much have you invested in the S&P 500? And you start laughing, trying to change the subject because you have no idea what they're talking about. Well, no worries, because today we're going to talk about why we invest in the S&P 500, what is the S&P 500, and how to invest in the S&P 500. So to start off, what is the S&P 500? What does it stand for? It stands for Standard & Poor's, and it is the top 500 stocks that are in the NASDAQ and New York Stock Exchange, and it fluctuates a bit. So it's basically the top 500 at any point. And you'll actually see later in this conversation that we are going to be talking about more than 500. So 500 is just about the average of what ends up being in that particular stock there. So down below here, we have a few different charts. We have this chart here, which is brought to us by Pages.Stern, New York University there. And they've put out a certain amount of information on different stocks. And then I also have another item in here. This is Bitcoin, because that's kind of like the hot new topic over the past few years, and what that looks like as an investment, and why I still like the S&P 500 versus that. And we'll start off with that particular thing right now. So we'll look across this, the thing here. So this row X, if you will, is the S&P 500. It includes dividends. It includes the dividends. We're going to talk more about that, about what does that mean. Then we have U.S. small cap. We have the 3-month Treasury bill, the U.S. Treasury bill for 10 years. And then the corporate bond. We have real estate, because I know there's quite a few people that love real estate. We have gold, and obviously there's more stuff you could invest in. You can invest all the way down into a single stock if you wanted to, or another type of commodity or something. But these are kind of the top, where it kind of looks over a large volume of stuff. So we're going to look at that. And this here is Bitcoin. So we're going to kind of scroll down the page, because you can see there's nothing here for Bitcoin. Obviously it wasn't created back then. So we're going to just kind of scroll down, and you're like, well, what do I do with all this data? I mean, there's a lot of percentages here, and what makes this so much better than this? Whenever it looks dizzying as you look through here and say, what am I looking at? And then over here, you'll see Bitcoin pop up, and you can kind of see the numbers that have come in on that, and some crazy numbers, obviously, over the past 10 to 11 years there. And you can see that it's just been continuing to climb. However, there's been some big swings, and that's where people are still not so sure where it's going to go. Could be better in the future, could be worse, we don't know. And so that's really the primary reason why I'm still holding off on investing in Bitcoin at this point. However, let's take a look at, what does this really mean? Look at all this data here. What does it really mean? Well, what it means is you've got to take the average over a certain amount of time period. So in this case, we're going to look at the last 96 years. So all the way back to 1928 to 2024, the last 50 years, 20 years, and 10 years. And the reason why you do that, you want to see if there's consistency. You can kind of see there's a bit of consistency here. There's not a whole lot of consistency here. You got, kind of decreasing here. So that doesn't look all that great for that. Then you've got this one, and you look at it and you go, well, looked like there was a little bit of consistency. Then all of a sudden it drops off. And then this here has kind of been up and down. So you don't really get a solid feeling on that. And then also real estate looks like it's been going up a little bit over the years. And then you can look at gold. It's kind of been hanging out around there. Not a whole lot of consistency there. And then, of course, Bitcoin. Now, Bitcoin obviously at 187%. I mean, that's eye-opening, obviously. Nothing has gotten that type of percentage, but it's also young. There's not enough data. And so you really want to have roughly 20 to 50 years of data in there to really understand, is this going to be something I'd want to invest in? Now, I do say that I invest a very large percentage of my money in the S&P 500 is because of consistency. But I do own a couple, or one stock at least, that is that I'm hoping goes up, but it has just tanked. It hasn't gone good. So what do? I kind of revert back, everything flowing into here. But it's always a little bit fun to take maybe 1 to 5%. I don't want to invest more than 5%, and I even recommend around 1%. Investing in stuff that you just don't know if it's going to take off or not. And that 1 to 5% may end up being Bitcoin in the future as it continues to grow. We may see that there's some starting to have consistency there, and it really take off because it is a interesting market and what it could do for us in the future. So whenever you look at it overall, you kind of look at the numbers here. You're looking for consistency and highest percentage, because that's really, the compound interest really is where you want to be. And if you just look here, nothing really compares to the S&P 500 over that long period of time. Even through the Great Depression, it's just continued to march up that hill, and or at least be in the same type of percentages there, whereas the other ones, they're just not there. It's kind of cyclical. It's kind of goes up then down, and so you really don't want that as an investment. You want something that is kind of consistent. And this is because you're investing in the top 500, but you're not just investing, in $1 split amongst 500 stocks. It doesn't just, they don't just spread it equally, which brings me to my next point. So the S&P 500, and I'm going to scroll over here. The S&P 500 is invested as such. So this comes from Yahoo Finance, and this is VFIAX. So this is a Vanguard fund that is a low-cost index fund that follows the S&P 500. So whenever we look at this, you can see the top 10 holdings in this stock. It takes up 37.32% as of today. You can kind of see the date there. And it's 37.32% in the top 10 stocks. So a lot of your investment is going to the top 10 stocks. And it only gets lower in percentage as it gets all the way down to 500, right? So and then if one of these were to tank, let's say something bad happens and one of these tanks, well, then it just moves up. Another one replaces it. Yes, the S&P 500 may go down a little bit, but it's going to be replaced again by another stock that is going to take its place, essentially. Some of the experts in the industry call it self-cleansing, if you will, where one stock could go bankrupt and then another one just takes its place and all is good. Not to say it won't be kind of up and down during that time, but the thought process is that it will be replaced. And so there is some security in that. Now, some people look at this and they say, well, gosh, yes, you do have that plus the other 500, but isn't it risky? And my argument to this is that what is risky is putting my money into something else that will make nowhere near what this will make. So some people will put their dollars in bonds or different types of bonds or real estate and stuff like that. And for some reason, they think that is going to smooth the ride, or it's going to make you feel good at night. And while that may be true, and if you're that way, fine, you can do that. I just prefer, no, let's put all, if not 95% or more. I'm going to say that 95% or more, put it in here. If you want to put some in something else to make you sleep at night, great. But I highly recommend 100% or 95% into this. It's so easy. We're going to talk about how we invest in the S&P 500 and how easy it is. But just rest assured, you're looking at the top 10 stocks here, and look at that. Everybody knows them: Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, Google. I mean, these are all known companies that you now own. So your $1, whenever you put it into this particular stock, this VFIX, it's going to be split up exactly this way, all the way across. And so, and we're going to talk more about diversification, but that is pretty diversified whenever you think about it. You own 500 stocks. You're not going after one stock. You're not just investing in Apple. You're investing in all 500 stocks. But you're also spreading that percentage from the top stock all the way down to the bottom. So that's important to know whenever you're talking about the S&P 500. Now, what does it mean whenever we say S&P 500? Why is there different data? Like if you go to the internet and you start typing in S&P 500, you're over the last 96 years since 1928, you're going to get different numbers, and you're sitting there going, well, why are they different? What is going on here? Why is it this way? Why aren't these all the same? I mean, it's the S&P 500, right? Well, this is the reason why. Whenever we go in and we talk about the S&P 500, there are two main things you have to look at. And one of them is, were the dividends reinvested? Now, whenever you invest in a stock, let's say you open up a brokerage account, they're going to ask, do you want your dividends reinvested? And some people call it the DRIP, right? So dividend reinvestment plan. So the answer to that is always yes. So the reason why is because of what we're about to look at whenever we start seeing the averages. But yes, you definitely want to reinvest those dividends. So we're now going to look at these two columns here, but let's take a look at what does that really mean in the below. Then the next thing is adjusted for inflation. Now this is where you need to decide, how are you calculating your retirement? Are you calculating it based on this number, and then you're going to adjust the inflation on your calculations, which I can't wait. In the near future, I'm going to be giving another video on this, which reminds me, hit that like button and subscribe. But the idea is that whenever you're looking at these numbers, you'll see that if you adjust for inflation, look at the difference here. We're almost 3 to 4% going into this, and even more here because of what's been happening on inflation over the long haul. So that's why whenever some people, whenever some of the financial people online, they say, oh, it's 10%. Well, some people say, no, it's 8%. Well, the reason why is because they're making an adjustment for inflation. So just know that whenever you're talking about the S&P 500, there's different definitions here. And then the ones that I don't really follow very much or look at is dividends reinvested being no, which means they're going to send you a check and every X number of, some of them are every 3 months, some of them are every month, whatever. But the dividend gets, literally, you'll get a check in the mail. Well, I don't recommend that because then you're taking money out of the market. But whenever you do that, and then if you do not adjust for inflation, you're going to get these numbers here. Well, you can see that if you don't do it for inflation, then you're kind of looking at this number to this number. So you can see there the differences if you don't reinvest those dividends. So pretty good amount of percentage there, and those percentages, we're going to find out whenever we do these counts how important those are. So always invest those dividends. And then the last one is just kind of basically what if case. If you don't invest dividends, but you add the inflation in, and you can see some of these numbers even go all the way down to 3% and so forth. And I don't recommend looking at these two at all, in all honesty, because I like to reinvest those dividends. And so whenever you look at these two, really it just comes down to, how are you calculating? Are you calculating inflation on your calculations whenever you do that, or are you not doing that? And you will see in a future video, I don't do that. I account for my inflation numbers and my percentages that I give in my calculations so that I can change it and things like that. So I'm focused on something like this, but I always use 10%. I always put a little buffer in there So I always use 10% and then I add inflation on top of that. So that is how you read the S&P 500 when you go to different websites. It's all about these different dividends reinvested or the inflation. Now, let's talk about how we invest in the S&P 500. I mean, this is the whole purpose of why we're here, is to figure out, hey, how do I get involved with this? How easy is it? And this is the primary reason why most people get involved in the S&P 500. It is just so easy. It's easy to invest. You can just open up an account with an online or you can just call one of the investment firms. The two investment firms I recommend, Vanguard and Fidelity. There are other firms out there. I just prefer these two. I actually have money in both of them. And so you could call either one of them. Very nice. They'll be able to set you up an account. And if you're completely new to investing, just tell them you want to set up a brokerage account. And that's a simple account to where we're not going to get involved with Roth 401k, Roth IRAs and all that stuff right now. We'll have future videos on how you can do that. But just open up a brokerage account just to get your money flowing. It's the easiest way to do that. And if you want to invest in and you definitely want to invest in one of the below ticker symbols. Now, these are the ticker symbols that I'm talking about. So whenever you go and say, what do you want to own? Well, I want to own VTSAX or VFIAX, or I want to go to Fidelity and own FZROX and FXAIX. So, and there's advantages and disadvantages to all of them. So we're going to go through that. But if you just call them, they'll walk you through how to set it up online, how to invest, and how to make automatic investments. This is the most important thing, is to automate this so you don't have to think about it in the future. So let's talk about how Vanguard does it. They have two different types of funds. One is an index fund. It's a low-cost index fund. The other one is an ETF, an exchange-traded fund. And you can see these are the ticker symbols for this. And you'll see people online just fall in love with ETFs. I do not prefer them, and I'm going to tell you why. But so that's why I've got these kind of more in a darker color and these kind of faded out. But whenever you look at this, we were talking about VFIAX earlier, and sure enough, that is 100% S&P 500. Well, whenever you look at that, it actually they actually own 504 stocks, not 500. It's 504, and that's because companies like Google have 2 or 3 different types of stocks, which we'll get into in future videos, and that just throws them over the 500 amount. So it is S&P 500, but in this case, with this stock, we're going to own 504. And so why do I have this VTSAX fund on here? What is this other index fund that is 80% S&P 500 and 20% small cap? What is that on here for? Well, the reason why is because we saw that, yes, this is the one that puts out the exact amount that we want. However, this here offers a little more risk but reward. And what I mean by that is the risk is that, yes, you're putting money in more of the small caps stocks. So if you just look at this, 3,109, essentially 3,100 stocks are in that small cap, and then the top 500 in there. But you can look here, it's 80%. So 80% is still going to the S&P 500, and then 20% is going to the small cap. Well, why would I do that? Well, because of diversification. So yes, I am 500 stocks here, but here I own the entire market. So as companies are coming in that are, let's say, companies like Tesla, they were small in the beginning and then they eventually grew. Well, I can take advantage of those stocks that are coming up during that time, and it will then, I could earn a little bit more. And if you look at VTSAX and VFIAX on there together, they're almost following the exact same curve, which is a steadily going up that hill. And that's what you want regardless. But you'll see that VTSAX is just a little bit higher. And I want to make sure my stocks that are in the S&P 500 are continuing to go up, but what a little bit of advantage. Now, whenever you look here, does not matter. If you're doing this one, great. If you're doing this one, great. Is this a little more risky? I would say no, because you're more diversified. However, this is safe because it's 500, but it's not as many, but you're almost, wouldn't say guaranteed because nothing's guaranteed in life, but this is going to produce, or is planned to produce, those returns that we were talking about earlier. Now, there is a couple things here that I haven't mentioned. The expense ratio, and you'll see 0.04 here. You got a 0.03, 0.04. The expense ratio, and then you can kind of see down here with Fidelity, and we're going to talk more about them. You can see theirs is actually a little bit lower. And this is the amount of money you're going to pay to the investment firm to own that stock. So whenever you invest a dollar in there, 0.04% of that dollar is going to them. Now, that is hardly anything, and they should get something for you owning that type of stock. So, but how much this is matters. Like if this was 0.1 or higher, I would not want to own that because it is just too much of my money being taken away for them to own it, for me to invest in them. So I'm looking for something that's below 0.1, and it just so happens that Vanguard and Fidelity have that. And there's other companies, like I said, that have that. And you can even see here, F0X is 0. So they don't even charge anything for that. And I think that's more for marketing and things like that, because that may rise in the future. These may rise in the future, but it's not going to be much because there's so many people that invest in them. So that's what expense ratio is. It's just a little bit of percentage that's going there. But if you're looking at your 401k at work, for instance, take a look at those percentages. That's going to tell you, is it a low cost index fund or not? Because that's what's going to be taken away from you every time you invest. So you just want to try to keep that as low as possible. And then the other thing is the upfront investment. So you can kind of see here for Vanguard, the top two, well, it says $3,000. So yes, you got to have $3,000 to invest in these two stocks, and you'll likely only choose one of them. But you have to have $3,000. Now, that's one pro that you could say, oh, I'd rather do the ETF because I can just invest in that. That is true. However, there's no way to do automatic investing with those. You got to invest it into your money market fund and then transfer it. So that's not easy. I like easy. So the idea is, how do I get it into that automatic investing? Well, I just have to save up the $3,000, and then it will I can set up the automatic investing, and then it's just great. Now, you can also see here that there's nothing on Fidelity. You don't have to pay any down payment, and you can set up that automatic investing. So this is an advantage to Fidelity. However, the thing that puts me over the top for Vanguard is that, yes, I can, the 3,000 is a little bit of a barrier, but I can save that up in my account, my savings account, and then invest all that 3,000 in and then get into it. Or, and I would rather do that because Vanguard is owned by its shareholders. So they have a different setup to where you have to, the shareholders, as you invest in that, you're owning part of that company. Whereas Fidelity, it's not like that. And that little sense of, I guess, ownership of the company just helps and just makes me feel good. So I do it that way. So I don't totally put all my money into Fidelity. I do have some money in there. And that's not necessarily because of anything other than my 401k only could go to Fidelity. But I do have some in there, but I have them in these funds that are low cost and in something either like an 80-20, or in my case with an, for instance, a 401k, had to do 100% onto that S&P 500. So between my different stocks or my different stuff that I've got either this one or this one. Either one produces the same type of results. So those are the two that I go after. But once again, all you have to do, call the investment firm. They will help you set this up online. Call Vanguard, call Fidelity, or if you want to go with another brand, that's fine. Just make sure it is a low-cost index fund. It has a low cost expense ratio, so it should be something like this. and it needs to have these types of splits. And then watch out for the upfront investment, just so you know how you're going to invest, and make sure you can do that automatic investing. I can't explain how important that is. But that is why we invest in the S&P 500. It's the most solid stock. It has the top 500 stocks for the most, well, in this case, it has the top 504 or 507 stocks in the stock market. Watch out for the different, whenever you're looking at the tables, as we mentioned, just watch out which ones you're looking at. Is it inflation, or does it have dividends, and so forth? But until next time, that is what we're talking about today. So thank you for listening. We'll talk to you later.